Good morning, everyone. If you guys hear any Bailey bark, that's my dog. So I'm not going to edit this, just a reminder. This is just a market review. From Friday, we had NFP, and I told you guys what I was thinking about for Thursday, that we were going to sweep sell side liquidity and then come back up. We didn't go as far up as I thought we were going to. I was expecting us to at least break previous day high. That didn't happen, but we did end up going up like I wanted to for NFP specifically. I was not interested in the sell because I thought the buy was pretty clear, especially because we were below previous day low, as you can see. And I was taking that into consideration, being a time-based liquidity. So we can delete that, but that was my point of reference. So I was trying to buy, actually, let me put that back on. So if we are below previous day low, this is the area that I'm trying to buy from. Anything below that, I'm not interested in selling in this area unless we already take buy side like we did. And then if you pay attention, we come back and like we reject it, then I might be interested in selling from previous day low. But I usually use it as time-based liquidity. In any of the sessions, you can actually use as an entry. For instance, if we break below London low, like here, where is it? Let's, okay, this is just being stupid. There we go. Even though that was a low, but that was another swing low. Anyway, you see, as you can use this as an entry as well. I think I'm going off topic. But yeah, there we go, like 200 points just from selling right there, using structure as your entry. Of course, finding a PD array within this, which would have been the breaker, probably would have gotten in, yeah, on the market structure shift right there. It's fine. So yeah, I'm going off topic right now. Anyway, so buying below previous day low. So how would I have traded the NFP? I'm not gonna lie, I did trade part of the move. I did not trade the whole move because I was at the gym. I was not expecting us to give me an entry like at 8:30. Like that rarely ever happens. Usually I'm looking for my entries 15 minutes after the fact. Hold on. My dog just broke some shit. Hold on. All right, sorry, I'm back. So I'm looking for buys below previous day low. So that's number one. Then I'm also looking for buys below midnight price and below 0830 price. So aside from previous day low, midnight and 0830 is 2022 mentorship. So those price points are very important. So you always got to remember that, right? And then I'm looking for my entries as well below London low. In this case, it happened extremely early in the morning, like at 5. So I would have waited for a second drawn liquidity closer to the kill zone for futures, which happened right here exactly at 8:30, right? So this was like very evident because as you can see, we have like this little trend line liquidity happening like such. So the way that I would probably have entered this would have been off the breaker, honestly. So then again, what is a breaker? We look for an intermediate low, a low that sweeps the liquidity. And then whenever we have a market structure shift past that point, then you could have gotten it. I don't like that 30-second breaker though. Let me look at the 15 seconds. Yeah, I would have put like a buy stop right there at this specific time. So waiting for us, forget about the wick because the wick is just manipulation. That's going to be your buy side liquidity, but you're waiting for a break of structure above the candle that took liquidity. So actually, I'm not going to mark break. I'm going to mark. So that would have been a buy stop. I have been using a lot of buy stops. I tend to think that it works better as far as keeping your emotions at bay. Because that way it's very mechanical, right? If you put your buy stop right there, especially with this big ass wick, I would just put my stop right at the last body and not the wick. So this don't consider the wick because this is like already like a big stop loss. And then you aim for the wick, which is wick is liquidity, right? So that would have been a good 1 to 2. I would still have gone as far as aiming for the Asian highs, which I mean we did go there. We went a little bit far up. But I ended up getting in right here on this candle. Yeah, because it was, let me look. I think it was a 3-minute fair value gap, maybe. Even though I want to say this is an implied fair value gap because this was just manipulation. Even though there is a wick there, so I would have to go lower on the time frame. Let me see. Maybe was it the 1 minute? Yeah. Definitely trading on the 1 minute. 30 seconds maybe. Hold on, my dog's breaking more stuff. All right, I'm back. Yeah, I'm just trying to find, I think it was the 1 minute that I got it. Yeah. No, it wasn't. It wasn't off a breaker. That's what it was. Sorry, it was a 30-second breaker. Yeah. So we traded back into this. There we go. It took me a while to remember what I did. There we go. So we had this drawn liquidity. This is a propulsion block, which is a type of order block. I just want to point that out. All right, I'll remember to lock my dog next time. He's being impossible. And of course, that candle is your breaker. So as soon as we take liquidity, you can put a buy stop right here as well. It'll get you in, unless you just want to wait for a change state of delivery, then you can use this candle. So I just put a buy stop right there. And then again, you long from here. Your stop loss, you want to make sure is below that wick. And then you aim for these equal highs right here. But I held for like a little bit longer, because at least I wanted a 1 to 2. So at 34, might have gone out around here, like around 60, 70 points, I want to say. I was expecting this to go a lot higher. I'm not gonna lie, it didn't, and I was upset that I couldn't get this entry, but it played out perfectly. I was able to make some money with it, at least on my live accounts. So essentially that's the stuff that I look for. Then again, time, right? 8:30 news, liquidity. And then you want to look for, you know, changing state of deliveries or market structure shifts. And then I just put my buy stops where I believe the market is going to break from. And yeah, and because that is considered a breaker is only considered a breaker, or what forms a breaker is the market structure shift, not the drawn liquidity, but the market structure shift after the drawn liquidity. So what else? Yeah, and how would you have caught this sell? Because we did start making a market maker sell model after the fact. So if you think like a market maker, right? We wiped all buy side liquidity after news release. And then we had these relative equal lows right here. Right. So this becomes liquidity now. And let's go to like a 5 minutes. I usually like to mark make buy and sell models on the 5. I want to say to 15 maybe. So okay, we wiped the buy side liquidity, right? So we're above Asian high. And this is why I get out exactly at these points right here. So these are my exits. Is because price can reverse. Price is done doing what it's supposed to do. The objective of the algorithm was to take buy side liquidity. Once the buy side liquidity is taken, what happens? Everything else reverses and becomes sell side liquidity. So we're trying to mitigate all the orders from the people that, you know, were buying. So these are very specific sensitive points in the market. Once we touch these points, I'm usually 9 times out of 10 out unless we have a higher time frame liquidity objective. So I would say that whenever we took this high right here, right? So this would have been your indication that price doesn't want to form new highs because we didn't have like a strong bullish candle. We just start having wicks. So this indicates failure, right? And I need to go to a lower time frame because I'm pretty sure I saw this fair value gap right here, but it was on the lower time frame. Yeah. So on the 1 minute, we already have a very messy breaker, but it is a breaker, right? Intermediate high, liquidity sweep, break of structure or market structure shift right here in like so. I don't want to say I would have gotten in right there, but that would have been your market structure shift. But what I was actually looking at was this fair value gap that created. Like I said, I'm very picky. I want to see a 3 candle pattern when I'm trading, right? So 1, 2, and 3. So I would have picked this one right here. And that's why I dropped down to the seconds, because I guess on the 1 minute you still could have marked it as well, like so. And you still be pretty accurate. But as you start going up on time frames, you see like on the 2 minutes, I don't like this fair value gap because there is a bullish candle right there. All right, so if you mark that, I mean, yes, it plays out, but it's not, I guess, as accurate as I would prefer it to be. So once we have that market structure shift right here, and you start seeing that now we are breaking, right, structure completely, energetically, that we had a displacement, right? And we created a fair value gap. Now price trades back into it. I don't particularly wait for the 50%. I just get in the beginning of it, like it's a 30-second candle, you know. I would not have put my stop right here because that's not structure, even though it's a 30 point. I would have put my stop right there. Maybe on that candle. Just because that's what structure is asking for, like I don't choose my stop, the market is going to show me where my stop is supposed to be. Because you technically could put your stop above the candle that formed the fair value gap, which would have been right there. And if you want to be picky with the 50%, that's how you would have gotten your stop to 20 points. But then again, you know, always risking that you could go back to this right here. And then you aim for sell side liquidity right there. And that is 100 points. Pretty easy trade, especially on NAS. And like I said, I like to mark my market maker buy and sell model and a little bit more of a high time frame. But as you can see, we had an accumulation. So that could have been like your original accumulation, and then first distribution. Maybe 5 minutes. Make it look better. Yeah, because your original accumulation should be right here. Somewhere around here. Because you want to get the low of the low, so like somewhere around there. Then first distribution right there, or second accumulation, whatever it is. And then smart money reversal right there, because that's where we got the drawn liquidity, SMR. And then you have your first stage of distribution. And then your second right there. And then again, I don't really mark these on my charts anymore. But it's nice to have an understanding. And the way that I explain this to the people that I've thought I teach, you know, is that with ICT, you don't have to mark everything, you know, but it's nice to have an idea of what it is, because when you see it, your brain will go back like muscle memory. You know what I'm saying? Like a reflex, right? So if somebody punches you on the face, your first instinct is to block it, right? Because that's just your muscle reflex. So with ICT, I try to do the same thing. Like I don't mark things on my chart that don't need to be on my chart, but when I see it, which is the accumulation, you know, and the distribution on the market maker sell model in this case, is that I am completely aware that after the second accumulation, after the first, I guess you can call this distribution, right? And we have a liquidity grab on a smart money. I can tell that this is going to be a smart money reversal, right? So I'm very aware that whenever we break structure, and now all the order blocks from this side of the buy side of the curve, because this is the buy side of the curve, right? I'll make a nice green line. So, and this is the most important thing about the market maker buy and sell model, that is very simple to understand when you put in layman terms, is that all the PD arrays that were on the left side of the curve, or in this case, on the buy side of the curve, will get inversed on the sell side of the curve. So you can use all those points from the buy side to the sell side. So that's where you get your inversion fair value gaps, your inversion order blocks, or distribution order blocks, whatever you want to call them. So all these PD arrays, especially if they align with a new PD array on the sell side of the curve, now you know for a fact that this is a mitigation that the banks are coming back to. So that's how mitigation happens. So all PD arrays from this side are now inversed on this side. And you can align this with that. So if you can see order blocks here, if you have a gap there, right? So this now is an area that I'm looking for PD arrays. And I don't know why people like have such a hard time explaining this simple concept to me. And your original accumulation, what is that exactly? As we know, once there's an accumulation and you break to the upside to take buy side liquidity, what happens on accumulations is that you come back to take the sell side, because that is liquidity. Right, so on accumulation, what happens usually, like if we break up, then we tend to come down and do like such, right? On my understanding as the market maker buy and sell model is that the original accumulation is there to, as far as my understanding goes, is that there's still liquidity that needs to be taken, right? And the name of the game is to trick retail traders. So now that we are buying, we're just gonna come back for the sell. It's as simple as that. Like, but this is just an understanding that I have in the back of my head. Is not something that I'm over here like looking for it every day, marking my accumulation, my distribution or whatever. I just mark my entries, but it's nice if you back test, and if you see it enough times, your brain is just going to start to see those things, right? Like fair value gaps. I don't have an indicator for fair value gaps anymore. I just see them, right? It doesn't matter which time frame. Like right here, we know this is a fair value gap, and now this is second nature to me, but it didn't used to be. I didn't like, it took me like a ridiculous amount of time to be able to mark fair value gaps for some reason. Like, but I don't need an indicator to tell me that this is a fair value gap. I just know. And like, I don't even need to mark my fair value gaps. I just know that it's a fair value gap. And I can just go over here, put a sell limit right there, right? And call it a day. Like, I don't have to mark things on my chart anymore, because I am to that point that like, I understand that this point is liquidity. So I can just, all right, boom, done, right? I don't have to mark things because it's second nature to me, because I've seen this and done this so many times. But for you to get to that point, you need to put in the work, right? And the only way for you to put in the work is repetition. So back test, mark as many charts as you can until you understand, like until it becomes second nature to you. I have a meeting that I gotta go to. Sorry about my dog being a nuisance in the first half of this, but I hope you guys took some value out of it. Until next time.